So how do you get rid of your PMI from your mortgage payment? Hi, I'm Jim Fong, and I'm an investor and realtor in Las Vegas, and I just like to help people find investment opportunities. First of all, let's talk about what is PMI, all right? PMI is private mortgage insurance, all right? So if you purchased a home and you put less than 20% down, if you purchased a home and you put less than 20% down, you will have PMI or mortgage insurance on your mortgage, all right? So it's usually an additional couple $100s on your payment, all right? That's just because you didn't put that much down when you purchased the home, so they want you to have a little more insurance, all right? So that's PMI, all right? But a lot of people are having these questions right now like, well, the market's gone up, value of my home's gone up, I think I have the equity position now. Can I get rid of my PMI? And the answer is yes. If the value of your home has gone up in value and you have more than 20% equity, you should definitely look into this option, all right? So let's talk about the different ways we can do this, all right? So first way, let's say you own the home for like 5 years and your principal is now like 80% of what it once started as, then you could probably have your PMI removed, all right? Or if you are in a very fast appreciating real estate market and it's only been say like 2 years, then they might require you to have 25% equity, all right? Just because the market went up so quickly, right? But usually these are the ways you do it, all right? The least effort for you is if you've just paid down your principal and you do have the equity position, you can ask for the bank to just remove your PMI, all right? So if your balance is 80% what the original balance was, you're probably good to go, all right? Another way you can do this is, now let's just say the market went up quickly and you want to see if you're in position to drop the PMI yet, right? Well, what you can do is call the mortgage company and you can ask them to reassess this. What the mortgage company is going to have you do is pay for an appraisal, all right? Once the home's appraised and they see the values there and they see that your balance is lower and you have that equity position, they could remove your PMI at that point. Okay, so the big advantage of doing it this way is if you've locked in a really good interest rate, right? What if you bought something in 2020, 21, or even 22 early on, and you have like one of these 3% interest rates, right? You don't want to give that up, right? So achieving this equity position will allow you to drop your PMI without having to refinance your whole mortgage, right? Because if you refinance your whole mortgage, you're going to have to take whatever interest rates are available now. So if you have a really good interest rate, you want to do it in a way where you can just keep that current rate that you have, especially if it's really low, all right? Which brings me to the other way, right? You can also refinance your mortgage, all right? Let's say you have a FHA mortgage, you put 3.5% down on it. Well, FHA mortgages never allow you to remove the PMI, all right? So in those cases, even though you have 20, 25, 30% equity, you'll never get rid of the PMI. You will have to actually refinance your mortgage. And, the benefit would be for you to drop your PMI. The disadvantage is now you have to take whatever interest rate is currently available for you. Either way, if you own a property and your equity's building on it and you have more than 20% equity, it's time for you to start thinking about dropping your PMI if you have that on your mortgage. So either way, whether you have to refinance or you've just paid down the principal balance or something like that, you should definitely look into that, all right? So yeah, thanks for watching. Be sure to subscribe and check out my other videos.